Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Tyler. How are you?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about is it time to sell or buy your stocks or your investments? And the reason we're talking about this today is that it's at the end of the year. And looking back at 2019, the market did increase throughout the course of the year, but it was relatively choppy. We saw 2, 3, maybe even 4 times we hit all-time highs, but the market went more sideways than it did up and down. If you look at it from that standpoint, if you can envision the graph that everybody refers to. However, what we're going to do is we're going to talk about with the gains that people have realized and some of the concerns that we hear a lot of people talking about, potential recession going into an election year, which Tyler and I discussed in a previous show, that, you know, going into an election year or the year of the election doesn't necessarily mean it's going to be a loss in the market. I think from the 1920s through the 2016 election, I think there were only 4 times that the year was down during the election itself, but it does create volatility. Now, remember, volatility is both a peak and valley. People always think volatility is just, you know, the lows. No, it creates that choppy feel in the market. The market's up today, down tomorrow, up today, down tomorrow. It's that sort of a sequence that is created with volatility. But we're going to talk about now, after 2019 is starting to come to a close, many people have gained, you know, significant growth in their portfolios. Is it now time to sell and move into cash, or is it time to buy? Well, there are different methods when we look at this. First of all, selling rate now, we're talking internally here, Tyler and I and the other advisors in the office here, we're talking about taking profits off the table. And that's a situation where you have potential gains in a stock or an investment, and all you're doing is taking some of those gains out of the portfolio, out of that particular investment, and typically reinvesting in something else. Doesn't always have to be reinvested. You can pool it into cash for a while if you do feel that the market is real high, which it is. So right now we are taking some gains off the table from our clients. We are pooling some cash because we believe there's going to be some volatility, which is going to give us some buying opportunities for our clients. It also gives us the ability to risk manage a portfolio, taking cash from the gains off the table when the market is high, and you have those gains to be able to buy when potential stocks or investments become low. It's something that everybody talks about doing when they start talking about investing, and that is selling high and buying low. Unfortunately, we see with most people, they sell low and sometimes buy high. So that's really not what we advocate here. But anyhow, taking profits off the table, we're not timing the market. We're taking some of the profits, moving them to the side, and many times we're reinvesting in another investment. So let's say your portfolio has 5, 6, 7 different investments. If you take some of the profits off the table, you can add maybe a 9th or a 10th investment, which is going to help you with some of that volatility by creating a little bit more diversification. Now, diversification does not keep you from market loss, but it does help stabilize and really level off some of the peaks and the valleys. So taking some profits off the table this time of year, good thing to do. Do we want to do that all the time? No, not at all. Tyler, anything else about taking some profits at this time of year?
Yeah, so first off, when we talk about whether or not it's time to buy or sell stocks, the short answer is there's really no right or wrong answer. It obviously depends on your personal situation. There's some people who would be best buying in right now and continuing to buy in, and there's others who would be better off by selling and taking some profits off the table. And when we talk about it right now, we have many people, mainly pre-retirees and retirees, that are utilizing the strategy of selling off a little bit and taking profits off the table. Part of the reason why is right now the market is at an all-time high point here in early December. Now there has been volatility so far through 2019, but in general 2019 has been a very good year. However, with 2020 coming around, there is as everyone knows, there is the election, and that tends to lead to a bit of volatility. So oftentimes right now, many people, they'll, as you said, Dean, they'll take profits off the table and reinvest them when the market drops. So it's not timing, it's simply selling off certain positions. And just as an example, there's plenty of people who hold Apple stock right now. And Apple is up over 60% so far year to date. So from the beginning of 2019 through early December here, you've made, if you held Apple stock over that time period, you've made over 60%. And as an example, let's say you had $10,000 in Apple at the beginning of the year. Right now, you'd have about $16,000 worth of Apple right now. So what that means is when you take profits off the table, you might sell off your $6,000 worth of gain, or even $2,000, $3,000, $5,000. So you basically give it a haircut back down to the original $10,000. So you're not dipping into and you're not selling off any of your principal. You're only selling off the profit. And what you can do is you can take that to rebalance and diversify. So right now there might be some stocks that have been beaten up a little bit, or they're not up as much as Apple. They still might be up a good deal or a good amount. But you could simply take those and reinvest them back into other stocks right now, or maybe even better yet, you could take that again, I'll go back to the example, $6,000 worth of gain on a $10,000 investment in Apple stock. You could take that $6,000 and go and keep that in cash for right now and use that to risk manage, where simply hold that in cash. And then maybe in 2020, when 2020 rolls around in just another month here, there could be a market dip, whether it's in spring, in summer, in fall, right before the election. And during that, a little bit of a downturn, you could take that and reinvest that back in when the market drops. So that's the whole in-depth idea of taking profits off the table to reinvest them when the market drops, not timing the market or anything like that. Whenever we have a big gain toward the end of the year, many people will do that to simply help diversify and get cash when they otherwise couldn't find cash at any other point.
Okay, and here's another example here too. Again, Tyler says we're not timing the market. We don't expect you to do that. We don't want you to do that. Part of the reason is people make more mistakes trying to time the market than just keeping their money in the market the full time. That volatility tends to strike. But as an example, last year in 2018, in November and December, the market went down pretty significantly at the end of the year. As a matter of fact, on Christmas Eve day, I think the Dow was down 19% from its high of 2018. We had heard that people were selling at that low. They were worried that we were going to go into another 2008 or something like that, so they were selling at a low. So what happened? They lost their gains. Much of their profit from the year was gone at that particular time. Then they sold where they didn't have a profit anymore. And then what they did is they sat in a cash position or a heavy cash position until April and May and missed some of that significant upturn. Why? Because they were, again, leery, thinking that maybe it was going to take a double dip or something like that. So what happens, again, people let their emotions come into play a little bit too much. We hear a lot of people say, well, there's going to be a recession. And we ask them, okay, how does a recession affect your investments? Well, I don't know. It's got to be bad. Not always. Again, look at economic factors, talk to financial advisors, ask them for historical information on past recessions and see where the stock market has gone. Also, you want to be sensitive to the fact that certain investments do better during recessionary times than others. There's a process called the business cycle. We've talked about this in the past. It's the ebbs and flows of the economy. You have a peak, which we are past peak right now. And as you start going past peak and start coming down, you have declines and you go into potential recessionary times at that point. Once you hit the deepest trough, sometimes that can be depression or a deep recession. Sometimes it recovers very quickly. The good thing is you start coming out the back end, you start going upward again into growth. But when you look at that, There are certain times that you look at profits, like right now in 2019, taking some of those profits off the table and going in and reinvesting in other investments. Well, it makes no sense to go back in and reinvest in the same investments that you're currently in. It makes more sense if you feel we're coming into volatility or recession to go into a little bit more defensive positions. This is a situation where you can go in and you can start buying some utilities. You can start buying maybe some beverage companies. So you want to go in and look at diversification, adding more holdings to your portfolio to give you a little bit more diversification to even out some of those peaks and valleys. But again, based on the business cycle and your concern that there might be volatility, consumer staples typically do well there. You know, the Procter & Gamble's and Kimberly-Clark and Clorox and so on. So Tyler, anything else on, taking profits off the table and reinvesting?
Yep. One last thing that I wanted to mention when it comes to taking profits off the table, that can go hand in hand with different tax strategies. And right now, when we talk about selling off a certain portion of your stocks, mutual funds, ETFs, whatever the investment might be, usually people sell off at a low point toward the end of the year if we have a down market, because that's called tax loss harvesting, where you can sell off your investment at a loss within any type of non-qualified or non-retirement account. So we have plenty of clients out there who have non-qualified, non-retirement, either individual or joint brokerage accounts where they're taxed every year. And what some people might do is they might sell off investment at a loss, and then they can use that loss to offset some of their taxable gains or some of their taxes in general to help better their tax position when they file their taxes. So that's when people will utilize tax strategies and sell off investments. However, keep in mind that some people, they can also look and do that when their investments are performing well. And what I mean by that is we have many clients that they came in and they had a portfolio where they might have a non-qualified account that they're taxed on every year, and they might hold a lot of different mutual funds within there. And usually mutual funds aren't as efficient in a non-qualified portfolio because they spit out capital gains every year. And if you have a substantial amount in mutual funds within a non-qualified portfolio and there's a lot of turnover, then you're going to get hit with a ton of capital gains. And what people can do is, if for example you're in a sales position and you have a bad year in sales, if you have lower income this year for whatever reason, you might have a new job, a job change. There's plenty of clients that we talk to all the time, and for whatever reason they have a certain year where their income is lower. Well, this might be the perfect time where you might have a mutual fund that has some gains, but it has higher fees, or it has a lot of capital gains that it usually spits out every year. Well, if your income is lower, now might be the time to sell it off and take some profits out of that and reinvest that back into cash and back into better performing investments, such as, or more efficient investments, I should say, such as single stocks or ETFs that are more tax efficient. So that's something else to keep in mind, where selling stocks right now, you can do that at a high point, even for tax strategies if you have a lower income this year.
Okay, before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions, located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, so we talk about taking some profits off the table, basically selling positions here. Again, at the end of 2019, don't necessarily know if that's for everybody. It all depends on your portfolio, what stage you're at in your potential retirement, whether you're younger. We typically like to see younger investors stay fully invested. They can weather the storm significantly better than those pre-retirees or retirees that we do like to take some money off the table for precautionary reasons and just to take a profit. But if you look at younger people invested, they have something going two things going that pre-retirees and retirees don't. Typically, you have age on your side, so of course you're going to be invested in the market significantly longer. And secondly, you have what's called payroll. Okay, payroll comes in every other week or every month, and you have money taken out of that going into your 401k. So when you dollar cost average that, if the market is down, you're buying more shares okay, at a cheaper price. That is a wonderful thing. So when the market is down and you're younger, you should be a little bit more excited about that than somebody who's older. Now, when you get older as a pre-retiree or a retiree, of course, we don't have as much time on our side. We'll have people tell us that they want this particular investment because it pays a significant dividend. That's good, but let's see how much time you have before you start withdrawing heavy off the account, because you still want to get some growth in there too, maybe a dividend grower versus a dividend value position. So you don't necessarily have time on your side, and once you retire, payroll is gone. So the portfolio has to stand on its own 2 feet. So you have to look at it a little bit differently than you do when you're younger. Okay, now let's talk about, buying some stocks. Is it a time to buy? Well, you hear people talk about the market being overvalued. It's very hard to find value. Well, what are you basing that on? You need to ask people, what are you basing the investment on? Is it the price per share, or the NAV, what the price is for the mutual fund? Could be hundreds of dollars, could be thousands of dollars. Some would argue that there are stocks worth thousands of dollars that are not overvalued. So don't look at it. Don't look at the retail price of the stock or the investment you're looking at. You need to look at the internal components to find out if they have enough sales and profit to support that cost per share. The other thing too is, how do you find stocks or investments that make you feel comfortable purchasing when the market and they are so high? Well, there are a couple things that are happening in the market right now that do give you buying opportunities. It seems to be when earnings reports come out on individual companies, they tend to be hit either harder or they grow more than we have seen in the past. So what's happening is, and we're not advocating these individual stocks, we're using them as an example. You need more time to look at what your objectives are before you can make recommendations. But just an example, PayPal, which was on a significant run in 2019, missed their earnings report, went down significantly, giving a good buy opportunity based on what they have achieved so far in their numbers. Another one would be Ulta Beauty Supply. I mean, they have not seen this type of a low in a significant period of time. Why? They missed their earnings reports. You had a number of hedge funds push them out of the portfolio. You had analysts say that they were no longer a strong buy, and they revised their numbers. However, you look at the stock itself, you look at all of the numbers that support it and their growth opportunities. It could be a good buy opportunity. Talk to your advisor about something like that. Another example of giving you a buy opportunity in today's market is geopolitical issues. Okay, right now we are significantly driven based on politics and geopolitics happening right now. Prior to the election, you hear every day in the news that we're getting close on a trade deal or we're getting further away from a trade deal. Those are geopolitical issues, political issues that are geographically based. Here we're talking mainly China, but also Mexico and Canada. So these geopolitical issues are affecting certain investments to create a buying opportunity. An example here is United Healthcare is a wonderful stock to be able to buy. However, because of talk of Medicare for All comes out, and those advocating Medicare for All would basically do away with the private insurance industry. Whenever that conversation gets hot geopolitically, politically, you tend to see something like United Health and many of the insurers go down. Well, again, look through the numbers, and if you see significant numbers supporting good growth, don't buy the stock at the stock price, buy the company. That's what we tell people. We want to hone in and buy good stock from good companies. Many times, if you're trying to buy good stock from a poor company, it could come back and bite you. You're going to see significant volatility there. Tyler, anything else about geopolitical or earnings reports?
Yeah, so with that, like you mentioned, Dean, it's something to definitely pay attention to because they can affect individual stocks and individual companies and the market as a whole in general an awful lot. And if you pay attention to those, it oftentimes creates the best buying opportunities. When here, like you mentioned, PayPal, United Health Group, there's so many different things that are going on geopolitically right now that can affect a stock one way or another. And right now, we found that in today's current market, that is what creates the best buying opportunities. But I also want to go and show an example. Right now, with the market being at an all-time high, there are many people who are reluctant to go and buy in. And I can understand that, especially for people who are pre-retirees and retirees and even younger people. But more importantly, those who are investing within a 401k, a Roth IRA, an IRA, who are in their 20s, 30s, or 40s, and they have a long time horizon, they have a long time period on their side, and they're investing for the long term for a retirement account, then it's pretty important that even when the market is at a high right now, you still try and dollar cost average and invest every single month within your 401k, your Roth IRA, whatever it is that you're investing in for retirement. Because of course, we'd all like to avoid the declines, and that anxiety that keeps investors on the sidelines may save them, the pain of any big decline, but it might also ensure that they'll miss out on the gain if the market continues to go up. And historically, each downturn, it's been followed by an eventual upswing. Now, there's no guarantee that that's always going to happen, but usually when it happens historically, that's a pretty good indicator of what's going to happen in the future. And trying to avoid risk could itself be risky if you try to avoid risk, because it's impossible to know when to get back in. So there's many people that we've seen that going all the way back to 2011, 2013, 15, 17, that at that time the market was at an all-time high and they didn't want to get back into it because they thought it stood more of a chance to go down. And here we are 11 years later, after 2008, almost 12 years later, and we still haven't had any major downturn. Now, that's not to say it's not going to happen, because obviously it will. It always happens. But still, if you sit out and keep your money on the sidelines, you're going to continue to miss out on big gains over the long term. So what I wanted to get at is, I've got a little example here where it shows that over a 20-year period, starting back in early 1999 to the beginning of 2019, so over the last 20 years, if you invested $10,000 every single year, so from 1999 all the way to 2019, $10,000 every year for 20 years is a cumulative investment of $200,000 that you would have invested. And let's say that you invest in an S&P 500 index fund. So that's simply a fund that tracks the S&P 500, the overall stock market, over those 20 years. And each year, let's say that you put your $10,000 in, and somehow you manage to pick the very worst day to invest. So every single day, and the very worst day would be the market high of each and every year. So if you pick the market high of each and every year, the worst timing there is, your average rate of return over those 20 years would have been about 7% per year. And your cumulative investment of $200,000 would have had a value of $415,000 at the end of 20 years. So that still shows, over the last 20 years, if you pick the very worst day to invest, you still would have averaged a 7% rate of return per year, which is still a lot better than simply keeping it and checking your savings over that long term. So again, that shows that even on the worst days, you still would have come out ahead. Now, if you would have invested on the best day each and every single year over 20 years, which would be the market low, you would have averaged about 9% per year. So just going back and running these numbers, I personally thought that would have been a lot different, but that just shows that, okay, it's about time in the market, not timing the market, is what matters most. So again, if you pick the very best day to invest $10,000 over 20 years, you would have averaged about a 9% rate of return per year. If you pick the very worst, it would have been 7% per year. So again, it's not about trying to go and time the market, trying to sell off at market highs, buy in at market lows. What you want to do is, over the long term, simply invest. And this especially goes for those people who are younger and who have time on their side. When you're retired and you can no longer put money in, obviously then it becomes a different ballgame where we have to risk manage and take profits off the table, like we discussed earlier. But this example is mainly to illustrate that it's about time over the long term, not trying to time the ups and downs.
Okay. The last thing we're going to talk about is, okay, if you want to stay fully invested, you're younger, you want to stay fully invested, but you don't want to be foolish with the volatility that's coming up here. You want to change your portfolio a little bit, maybe to become a little bit more defensive. Look at some of the largest blue chip dividend payers at this particular time. Dividend payers, if they're paying a dividend, it typically means that the company is a little bit more mature than the growth companies who are reinvesting all of their money instead of paying dividends to their shareholders. So you get some stability there. Secondly, you want to look at geopolitical issues and say, okay, do I really want to be invested in anything outside of the U.S. at this point? You can, of course, but I'm just talking in general terms here. You might want to look at, large U.S.-based stock positions, dividend payers, again, blue chip. And you might also want to look at some of those based on the business cycle we're in. And again, the business cycle we're in, we're past peak. We're starting to come down the backside a little bit of the economic numbers. And there you might want to look at some defensive positions. Defensive meaning, some of the Coca-Colas and McDonald's of the world, some of the tobacco manufacturers, if you wanted to invest in those. Also looking at utilities. Typically when times are bad, people are still trying to keep the lights on. Okay, so utilities and water. And also consumer staples. People still find the ability to go to the store and buy, the toilet tissue and so on. So those are some of the things you might want to look at going forward if you're feeling uncomfortable about the market. Of course, we would recommend you sit down with a financial advisor. We'd love to hear from you. We can take you through what we think 2020 is going to look like, give you a complimentary review of your current portfolio. Tyler, anything else that we should talk about going into 2020, whether it's buy or sell?
Yeah, Dean, just with the last thing here when we're talking about whether it's time to buy or sell stocks, obviously, again, it all depends on where you're at and what your strategy is. But when we talk about shifting in and out of different sectors, right now there's plenty of tech companies that we feel might be a little bit overvalued. And as you mentioned, Dean, simply shift valued and growth tech stocks like that into defensive, utilities, consumer staples. Another thing that I want to mention is different, not only dividend payers, but dividend growth stocks. So stocks that still offer good growth potential, but yet they offer a good dividend. You might have something like Apple, Microsoft, Visa. Different companies like that are considered dividend growers, where they pay a dividend that can help flatten out and level some volatility, but at the same time, they also are positioned for growth over the long term as well. So just want to make sure that you diversify. And heading into 2020, who knows, it might not even happen, but there will be a time. Recessions happen all the time, and whether it's 2020, 2021, 2022, or even past that, you always want to make sure that you're diversified and that your portfolio can weather the storm if we were to have a downturn. And again, with 2020 being an election year, I'm sure there's going to be some volatility, whether it's early or later in the year. Who knows? But that's usually what happens, is a little bit of volatility during an election year. But again, time to buy or sell stocks all depends on your strategy. If you're younger, you might want to look to continue to invest. If you're a little bit older and retired, you might want to take some profits off the table.
Good points, Tyler. That's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.